Good morning, everyone, and welcome to our continuing learning webinar, Connecting Planning and Philanthropy. My name is Kate McKenzie, and I'm the Assistant Director of Development for the Pittsburgh Foundation, and I'm joined today by my colleagues, Amy Ratham and Mallory Reese, who is with our affiliate foundation, the Community Foundation of Westmoreland County. And by now, we're all very used to these virtual meetings as a part of our daily grind, aren't we? But it means you're total pros at this, watching webinars. But of course, we wish we could be with you today, and just wanted to let you know that we will see you very soon, hopefully. And as we consider topics for this event, it was impossible to avoid how COVID has touched each of your areas of expertise and the clients you serve. And so as such today, our speakers will provide content on how to create opportunities by having charitable discussions with your clients and develop sound strategies to take advantage of low interest rates, changes from the Secure Act, and other methods to assist you with clients and their personal philanthropy. So before we start with our two fantastic speakers, I would like to just give you a couple of housekeeping items. This webinar is being recorded, and we will be posting it to our YouTube channel in the coming days. So if you'd like to review it or share with your colleagues, we would love that. A second reminder, we'll be sending a brief survey after the webinar broadcast. And this is really for us to gather information so that we can report credits if you're here for your CFP or CPE credits. And send your certificates to you. So if you could take a peek at your email inbox and fill out the survey so we can get the information that you need in order to get those credits. You'll be noticing throughout our broadcasts that we will have polling questions pop up during the presentation, and we'd love you to weigh in. Just a note, if you do have dual monitors on your computer, you might have issues answering the polling questions. So you might just want to go down to one monitor. So I would love to get started. Today's speakers are Greg Allison, shareholder at Schneider Downs, and Doug DeNardo, partner at Galanter Tomosovich. Greg focuses on estate and succession planning for business owners, executives, and high net worth individuals. He advises his clients in the automotive, oil and gas, transportation, construction, and real estate industries. And he assists clients with complex tax issues. And those are impacted, as you know, by multiple aspects of federal and state laws. And most importantly, Greg certainly walks the walk when it comes to volunteerism and board membership. And we're really lucky to have him at the Pittsburgh Foundation as a part of our professional advisors committee. Doug is in the Estates, Trust, and Taxation Department, and he represents clients to develop strategies to meet their wealth transfer goals. And he counsels clients on asset protection planning strategies, assists landowners in shale gas matters, represents charitable organizations in all facets, and he is a very good human on top of all of those things. He's been very giving of his time and talent to organizations in our region, and that includes the Pittsburgh Foundation as a longtime member of our professional advisors committee. So thank you both so much for joining us today, and I will let Greg get started with his presentation.
All right, Kate. Thank you, Kate. And you know, as Kate mentioned, working with the Pittsburgh Foundation and Doug, I'm honored to be here today. I'm going to share my screen as I just started and open up the slideshow and get into some of the topics that I'll be addressing. So just to give you a little bit of lay of the land, I'll be going for about the first 20 to 25 minutes, and here are the things that we're looking to cover at the beginning. And then Doug will come in and back clean up here for the second half of the hour. So what are some of the things we'll talk about in the first 25 minutes that I'll be covering with you? Well, first we'll be looking at what's happening to create these, we'll call them unique, and I don't want to say unprecedented, but at least very rare estate planning opportunities that we're faced with today. So we'll go over some background on what is happening to create these outside of, you know, the more general, oh, you know, this COVID pandemic. We'll drill down just a bit more. Secondly, we'll I guess take a couple steps back and talk about starting and having the client discussion. Now, you know, very mindful that all of you attending today were, you know, obviously invited because of your relationship with the Pittsburgh Foundation. So, you know, I know that you all have your, you know, a way of dealing with and talking to your clients about these things. So, you know, you certainly have been successful in that regard. But nonetheless, it doesn't hurt to share some thoughts and ideas. I know some folks, whenever they say I had a client discussion about charity, it basically goes, what did you want to do about charity? And obviously we're going to talk about ways in which we can have a more effective discussion. We're going to talk about some more technical things next, some more planning opportunities, if you will, which is disclaiming a charitable remainder trust present interest and why now might be a good time to be doing that, or at least considering that. And then finally, before we hand it over to Doug, we'll be talking about why and when to convert the private foundation. So with that, let's talk about what's happening to create these opportunities. So what I have in front of you here is a Dow chart from January 1st to June 1st. And again, being mindful that I know I'm on a webinar with a lot of folks that are wealth management kind of experts. You could probably take over and run this part of it, but nonetheless, I'll lay the land for you. What we've had is a pretty unique 6.5 months or 7 months, right, to say the least. We went from, and I've noted a few milestones on here. We started the year at almost 29,000. We hit a record high in the Dow in February of 29,551 for a close, that is. And then we set a record again on March 9th. We had the largest single day plunge in history when the Dow fell 2,000 points. And that record lasted for a whole 3 days until it was broken again on the 12th, when it fell another 2,300 points. And then yet again broke again 4 days later when it fell almost 3,000 points in a day. So what's happened since then? Well, since then we had our I'm going to say record close, because it certainly wasn't a record close, but our most recent low close on March 23rd. And since then we've kind of crept back up a little bit. A lot of volatility in the market. You can see the spikes. Where we are today, I didn't look when the market opened here a little bit ago, but as of yesterday's close, we were at 25,446. So pretty much where we were whenever I cut this chart off here on June 1st. So a lot of volatility, quite a bit of recovery, but we're still down 12% year to date. And we're at a level where we were in this market about 10 months ago. So what I think is kind of interesting, everybody has, an opinion. I'm not sharing an opinion per se, but, when you look at this, you kind of wonder what would happen if there were a resurgence in the fall, right? I mean, we're still down, right? And in looking at what happens to create these opportunities, the takeaway here is that we have a volatile market, that maybe still has some recovery to go, but at least has had some losses, if you will, over the last 6 months. So, where are we going to be come September? Where are we going to be at the end of the year? It is an election year, a lot of uncertainty in this. So, there are opportunities here as far as looking at, okay, we have a little bit of a down market. What can we do from a planning perspective to take advantage of that? So that's one of the first things that's going on right now to create these opportunities. The second thing to touch on here is the interest rates. So again, being mindful who I'm on the call with, I don't need to go into too much detail, but this is an effective Fed funds rate chart, again, from January 1 to June 1. January 1 of 19, though, I went back a little bit further on this one. Real quick, right, the Fed funds rate, it's a rate that's set by the FOMC, which is the Federal Open Markets Committee. It's kind of the rate in which banks are supposed to use, or at least benchmark, to trade their excess reserves on an overnight basis. So that target right now is 0 to 0.25%. So the effective Fed funds rate, actually the overnight rate from June 23rd was 0.8%. So that's the actual rate in which banks are, or the average rate in which banks are dealing. So what's the takeaway from these two slides, or what are we trying to get at? This is the environment. The environment is volatility and low interest rates. So when we have volatility and low interest rates, what does that really mean? What it means from an estate tax side, and from an estate planning side, I should say, and from a charitable planning side, is that we might have depressed values, both in securities and in closely held businesses. So, I think the security piece is pretty self-evident, right? But how do we then draw a correlation and say, hey, Greg, because I've got volatility and low interest rates, how is that impacting my closely held business valuations? I'm sure a lot of us deal with closely held businesses and closely held business owners. Well, what's happening there is that's basically increasing or impacting your capitalization rates, right? A lot of times these closely held businesses are valued based on cap rates, or maybe possibly earning multiples with lower earning projections, right, that a lot of companies are coming out with right now. So when you have a higher risk, you've got higher cap rates, right? You've got maybe lower earning projections, and then that's going to turn into lower valuations of closely held businesses. You also have intra-company, intra-family notes, right? I mean, if you've got a note on a company that says, hey, here's $1 million note and it's payable over X amount of years from an intra-family perspective, what's the value of that note? Well, right now that actually might be a little bit less than it had been about 12 months ago, because the likelihood of getting repaid on that might be a little bit less, right? So there could be more risk in that. So there's a lot of valuation components, and we could go on for hours, but the takeaway is, low interest rates, high volatility equals relatively lower valuations for a lot of closely held businesses as well. So, and I know Doug's going to talk about some strategies that kind of piggyback off of this environment. But again, in taking a step back, the next thing I wanted to talk about is having this discussion with your client. And in having this discussion with your client, I think, it comes down to a couple things. And I'll talk about these three things here in a second. But before we get into that, I think a lot of us, and at least I do, I have the tendency sometimes to, when I'm talking with clients, like to jump right into the financial aspect and like to show them these fancy schedules that we like to put together, right? But I think another part of our responsibility in our relationship building, frankly, with our clients, is to get our finger on the pulse of their personal happiness as well. I read a book, and it's called Money Can Buy Happiness by MP Dunleavy, and I actually heard her speak about a year ago. And for it to be clear, I don't get commissions on that. I have a very smart career choice of charging by the hour, not getting commissions based on royalties. So I have no affiliation to her, but I read the book, and it's interesting because it talks about how that money can buy happiness, and her research indicated that it can buy happiness in the form of experiences. But generally speaking, the more that people spend on things isn't increasing their relative level of happiness. So it's a really interesting concept. But the takeaway is that, I think we need to be having more discussions with our clients and be more comfortable in talking about non-financial matters with our clients. And one of these things has to do with charitable planning, right? There's certainly a financial component to charitable planning, but there's a very large non-financial, and I might argue in most cases a larger non-financial reason why folks do charitable planning. So what I found and what we found is that when and how these discussions happen kind of dictate what our comfort level is with three main things. So what's the first thing? The first thing is, how much do you know about your client? I'm sure we've all probably had situations where maybe you're thinking, I really want to talk to my client about this, but you've known your client for 5 years and you're almost afraid to ask him a question that you think that you should have known after 5 minutes of meeting them, right? So how much do you know about your client? I think the more that you know and the more comfortable you are with your client, the more you can have discussions that are new or maybe a little bit uncomfortable, right? And I mean uncomfortable in the sense of you've not had them before and you don't know maybe how they're going to react, or you don't know what the answer is. The other thing is, how much do you know about the charitable community? And I'm going to talk about each one of these three things in the coming slides, so I'll drill down a bit. But we found that the more you know about the charitable community, right, the more that you're willing to talk and have these discussions. Are you almost afraid whenever you ask the question, what do you want to do about charity, right, just generally? And they say, I don't know, tell me some options. What are some organizations and what are some community organizations or public charities that I should get involved with? And you might be afraid they're going to ask the question. So how much do you know? And lastly, how much do you know about the planning options? I'll go out on a limb and say that's probably most of our sweet spots, maybe, some of the relationship stuff as well. So generally we're pretty comfortable with these sorts of things. But nonetheless, these are some of the areas that I think we need to challenge ourselves. Are we comfortable enough? And then that'll help us in having these discussions. I think in generally speaking, we tend to raise areas in which and talk about things in which we're most comfortable and kind of avoid some things in which we're not. So, with this kind of lead in here, I'm going to turn it over and we'll open up our first polling question to get some feedback on maybe your comfort level and how you approach these discussions.
Okay, our polling question is, how often do you have non-tax discussions surrounding charitable contributions with your clients? If you could select one, every meeting, once a year, only when my client asks, or never? I'm going to give you about 10 more seconds. Looks like we are at 53%. Oh. Okay, I'm going to close responses now. And it looks like 53% said once a year, 28% said every meeting, 18% said only when my client asks, and 3% said never.
All right, thanks for sharing, Kate. So relatively even among the first couple, which is kind of, I think, what our experience has been as well. So in talking about starting the discussion, how much do you know about your client? Just some interesting stats that I found. And this is from a 2013 survey. I'd imagine they're probably relatively similar, but today if you would redo them. But clients feel advisors bring up charitable giving 17% of the time. And I didn't write them down, Kate, but that sounds pretty close to how often we talk about it with our clients based on the polling results. But the disconnect here is 88% of advisors claim this is an important topic, right? I mean, I think that's why a lot of us dialed in today. So there's certainly a disconnect. So I think this is showing us we probably should have this discussion a little bit more. 70% of charitable discussions center on technical tax issues. Again, probably no surprise because that's the area that we tend to be most comfortable with. But the clients are generally more interested in values, ideals, and charitable goals. And I use the words generally, right? I know we all have exceptions to a lot of these things, but I think that's a good generalization. Charitable plan, I want to talk to you about this. We started doing this for a few of our clients, and it's been really well received. Do you have a charitable plan, or have you worked on a charitable plan with some of your clients? I think, looking at the attendees, some of us probably say, yeah, I have a financial plan with my client. Maybe some of us as business advisors work on business plans with our clients, right? Maybe some of us have estate plans with our clients, but what about charitable plans, and what about personal plans? Do you actually have a written document? Do you have a mission statement? Do you have something that the client and their family have worked together on to articulate? Have they laid out in their plan current actions they want to take? Maybe they know they're going to make $100,000 of contributions a year, and they're going to go through in every November, and they're going to divide it up among the charities. I have a client we do that with, where we show, hey, each of the last couple years, here's how much you've given to each of these 70 charities, and then the client and their spouse go over this every November and they reallocate the funds. So we have a plan where we do that, and that's kind of a current action. Do you have future actions in your plan? Do you have something where you say, here's what I want to do upon my death? Here's something I want to set up in 5 years or 10 years. I want to set up an advised fund, or I want to do a private foundation, right? So I might challenge us to think about doing some of these charitable plans with our clients and having something you actually write down and revisit. And I think it'll make that so much easier in having these discussions more often with your client, because you have something to reference. You have a piece of the agenda to work on. Last comment is, I think that a lot of times we focus on this from a monetary perspective or an emotional perspective, but what about a time perspective? I think, just because a lot of our clients might be so busy where we have a harder time getting them on the meeting agenda sometime, or getting them in the office, well, at least on Zoom or Teams now. I don't think we want to just assume that their charitable intentions don't involve doing some actual time. And so I might challenge us to say, have we talked to our clients about that, and is that part of our charitable plan? Next thing is, again, how much do you know about your charitable community? I think this is a pretty simple slide. I mean, if you don't know a lot, we got to get educated here. I like to think, I look at this, there's an analogy I kind of think of when I think of this is, in Pittsburgh and Westmoreland County, right? I think of it as a quarterback versus the lineman analogy. They're voting for all pros, and everybody probably has an opinion on what quarterbacks are the best quarterbacks in the league because they're seen often, right? Those are your zoos, your museums, right? Your bigger ones. What about those linemen, right? What about the linemen that don't get the notoriety and they're doing some amazing things? This is where it's harder for us, and at least me, maybe some of you have a better grasp on who are those linemen that deserve that Pro Bowl vote. And that's where I think partnering with like the Pittsburgh Foundation, like working with, just reach out and have lunch with Kate, have lunch with Amy Rasm, have lunch with Mallory Reese, right, in Westmoreland County. The resources they have on what they know about the community is something that I know I just can't learn. So use them and have them help fill in these gaps on what you don't know. And lastly, before we kind of have one more slide to get out of the planning discussion part, how much do you know about the planning options and techniques? I mean, pretty simple slide here. I mean, I think this is the area we're generally most comfortable with. If you don't have an expertise in this area, you can develop it. I'm not advocating this CSPG designation or CAP. I'm just letting you know, if you're trying to hold yourself out or kind of evolve into your knowledge of what you're doing from a charitable perspective, there are some designations out there. There's probably more. Again, I'm not saying these are the best ones by any stretch. I know I'm not too familiar with them. But you could look at a designation, and again, know your limits. When you're having these discussions, know your limits. If you're not an attorney, you've got to have these discussions, and you'll need to work with an attorney that you feel comfortable knows how to draft these documents, knows how to do a charitable lead trust, right? Knows how to draft private foundation operating agreements. Also know can you handle investments and endowments? I think a lot of the folks on the call would say, yeah, that's my sweet spot. But if it's not, who are you going to use for that? And lastly, do you understand fund foundation due diligence, administrative, self-dealing, so forth? Depending on the type of charitable work the client wants to do, if they want to do something complicated like a private foundation, there's a whole nother area of expertise there, and you got to know where your limits are. One last slide I have on this is this is a way to maybe approach this discussion if you're looking for other ways to do this. I think if you can maybe have a discussion with your clients about the buckets, right? Hey, client, let's talk about your 3 buckets in your financial picture, or in just your picture. Here's your bucket, the red bucket, right? Do you have enough money, resources? Have you accumulated enough, right? You've got an up-and-coming 40-year-old couple, let's say. You've provided for your necessities. You've kind of worked on and maybe provided for your retirement already, and you've got some reasonable luxuries, right? So you filled up your self bucket. And then you start having children and you're saving for college and you want to think about what do you want to leave your kids whenever you pass away. And that's your green bucket, right? That's you taking care of your family. Well, sometimes when you get to the relatively wealthy, as I'm sure we all have some clients that might be like this, you might be talking to them about what they're leaving to their kids, and they're doing these trusts that have all these restrictive provisions, and it might go down 8 generations because they don't want to give more than $100,000 a year to a child. So what do you do from there? Well, let's talk about that blue bucket with our client. Hey, client, you filled up yourself, right? You've taken care of your family. You've obviously seen like that you've given enough to your kids in your estate plan. What do you want to be your legacy? What about outside your front door and your back door of your house? What is your legacy? And that's where I think this charitable discussion can really start to gain some legs. So moving on to the third topic, and I've got about 8 more minutes and then I'll turn it over to Doug. So I'm going to cover 2 more topics relatively quickly. Disclaiming a charitable remainder trust. First of all, what is a charitable remainder trust? A charitable remainder trust is a trust that says that an individual, a donor, puts, let's say, money into a trust. And it's split up into 2 components, a term or present interest component and a remainder component. So a charitable trust might say, and I have a hypothetical one right here, it might say, hey, I have a client who says, I'm going to put $1 million cash into this trust, and I'm going to take $80,000 a year for 10 years, and they're going to get $80,000 annuity for 10 years. And at the end of that 10-year period, whatever's left over is going to go to charity. So in setting these trusts up, there's many benefits to these trusts, but one of the benefits is the client or the individual gets a charitable deduction now in the year they do this, even though the money doesn't really make its way to charity for 10 more years. So the client gets an annuity interest, right? You value that present value, that $80,000 annuity per year. And let's say in my example here where I use the 0.6% rate, which is actually the July rate as well. It is $774,000. So the present value of the remainder interest is $225,000. Remember, the remainder is what goes to charity. So that's the value of my charitable deduction. So my client in this situation got a $225,000 charitable deduction by doing this charitable remainder annuity trust. So that's basically what a charitable remainder annuity trust is. Now, I'm not necessarily saying today is the ideal day to do it. We certainly have clients doing it now. I think Doug's going to talk about a charitable strategy revolving a charitable trust. It's a little bit more maybe bang for your buck right now in our environment. But what I'm talking about is something called a disclaimer. So what if the donor, and there's 2 big ifs here, what if the donor, A, has the charity that's the remainder that could really use the funds now? And I think that's, I put a star beside this because I know there's a lot of charities that could really use some funds right now for some good things. And then B, what if you have a donor who could really use a charitable deduction now in the present year? You might be saying, well, Greg, this year a lot of stuff might be down. Why does my client need a charitable deduction? We actually have a lot of clients that are doing a few things this year. They're accelerating income this year, a lot of clients. Well, why? Well, maybe they do have some stuff that's down and they're looking to offset those losses. Maybe they're looking at a 2020 election and a 2021 potential regime change that could be higher tax rates. So you have a lot of clients that actually are maybe looking at accelerating income for 2020. So maybe they do or could use a charitable deduction this year to help offset some of that. So if you have these things going on, what can you do? Well, what we could do is we could disclaim that unit trust interest. So let's say in my example that I just gave, my donor is 4 years in. So they have 3 years of payments, right? So they have $160,000 worth of payments. There's an $850,000 balance in that trust account. And they still have $560,000 worth of payments remaining. They have 7 more years. So if they disclaim that, they're giving up their right to that $560,000 over the next 7 years. So what happens here is the client gets another charitable deduction. So the client gets a charitable deduction that's generally equal to the present value of the payments that are remaining. Now there's some exceptions to this, and if you have a unit trust, fair market value comes into play, but again, just generally here. So you're going to get a client that's going to get about a $510,000 charitable deduction this year in doing this strategy. So there you can see that if you have a client who doesn't really need the funds and who has some of these charitable intentions and maybe is doing some tax planning, disclaiming a charitable interest in a charitable remainder trust could really generate that. Then what happens here is the charity doesn't have to necessarily wait and receive only $80,000 a year. Since they own the present interest and since they own the remainder interest, there are instances in which you can merge that all together and the charity can essentially just take the balance of the $850,000 in the account and can use those for whatever purpose was designated in the agreement. So this is something to keep in mind. Clients can also partially disclaim, right? So you don't have to disclaim the full amount, you can disclaim a portion of it. And then lastly, just some technical stuff. They should obtain a qualified appraisal. We don't always see that. That's a should thing. But nonetheless, Form 8283 should be done in connection with all this. So keep this in mind. I think it could be a really nice strategy. I know we've done this a few times already. So keep this in mind. It could be a good strategy. So we'll turn it over to polling question 2. I'll come back for about 3-4 more minutes, and then we'll turn it over to Doug. So polling question 2, Kate.
How comfortable are you if a client asks about choosing between a donor advised fund or a private foundation? Please select you're very comfortable, it's your area of expertise, you're somewhat comfortable, you know the basics, or you're not very comfortable. You refer these questions to another advisor. Give you a few seconds to answer this question. And I'm going to close it. It looks like 47% of you are somewhat comfortable, that you know the basics. 45% are very comfortable, and 8% are not very comfortable. Thank you for answering our poll.
Yeah, thanks for sharing that info. Okay, so let's say 50-50 on this next topic that we're going to talk about. So why and when to convert a private foundation, right? So let's say you've already had this discussion with a client, you set up a private foundation. There's one in existence right now. What is a private foundation generally? Okay, well, it seems like 50% of you already kind of generally know, so I'll be quick. There are 2 types of private foundations. Well, there's kind of more, but 2 general classes, operating and non-operating. So an operating private foundation, think of a museum, right? A library, zoos. Non-operating private foundations, right? Those are ones that you don't really see because they're not necessarily operating, but some good examples, the Forbes Fund, you've got the Pittsburgh Promise, the Coffin Foundation, Neighborhood Allies. There's some other ones in Pittsburgh too, like the Buell Foundation and McCune. I think McCune's actually sunsetting in 2029 or 2030, something like that. But nonetheless, those are types of non-operating private foundations. They're more about the grant making. They're doing due diligence. They have a pot of assets. They're making distributions of at least 5% of those assets each year to operating foundations or public charities. Generally speaking, it's the public charities. If you're doing it to other foundations, there's these expenditure responsibility things, so it gets kind of complicated. But essentially, you've got a private foundation. Most of our clients, I would venture, set up non-operating private foundations. I'm sure there's some exceptions here, but I think most of our clients aren't setting up museums and zoos. So they're setting up these non-operating private foundations, right? And what's the typical one? You've got the family on the board, they've got a pot of money in an investment account, and they're making grants, right? That's kind of what we typically see. One of the benefits is they only pay tax on the investment income and their rate's 1.39%. So a couple benefits, right? Control, like I said, the family can really play a role in it. There are self-dealing rules you have to watch out for, but the family can play a role. There's a legacy component of this, right? Mary Smith can name hers the Mary Smith Family Foundation, right? So it can have her name on it. And family ties, you can get the family to work together, and there's a lot of other benefits. However, sometimes it makes sense to convert. So what are some disadvantages to a private foundation? Well, the organizational and operating expenses can be relatively high. You're not generally setting up a private foundation unless there's at least, I'd say, $250,000 in assets, and frankly, that's probably even a little bit low. because there has to be annual tax returns, there's record keeping, there's bookkeeping, there's due diligence requirements, right? So there's a lot of stuff that goes into this. The other disadvantages are there are lower deduction limits to private foundations. There's 30% limits, 20% limits, right? So it's a little bit harder to get the bang for your tax buck here whenever you're making contributions to foundations. Next is the administrative complexity and penalties, right? There's self-dealing rules I teed up earlier. There's this one rule, it's a self-dealing type of rule that you're not allowed to provide goods and services to disqualified people. So if Mary Smith sets up her private foundation and the private foundation's operating out of an office in her office building that she owns, you could be running into trouble there. So there's a lot of complexity. And lastly, it is public. I mean, the records are subject to inspection. I think 3 years worth of 990s are a matter of public records. So what happens here whenever some folks want to convert? Well, we saw this in 09. Sometimes directors of these private foundations are seeing the value of their assets deplete. Maybe the admin costs are going up, the due diligence requirements are difficult. So let's look at an example, and then I'll finish up on the last slide here. Mary Smith contributes in 2010 $2 million to her foundation. So at the time, she hired an executive director and other advisors, and her expenses are about $100,000 a year, which is 5% of her assets. So then she also has to contribute, or distribute, I should say, another 5% of her assets every year, right? So Mary Smith's saying, okay, I've got a 10% burn rate on this thing. If I can generate 5, 6, 7%, maybe I can get 30 years out of this thing, right? And that's maybe what she wants to do. Well, fast forward to 2020. In 2020, let's say, with the market corrections and things going on, maybe the assets are only worth $700,000. Well, now Mary's still spending 100 grand a year. And so now she's spending 14% of her assets, plus she's got to distribute 5% as well. So you can see right now she's spending 3 times as much on admin costs as what's going to charity. So is this private foundation really fulfilling Mary's wish of maybe distributing money to charity? Well, it seems like it's really doing more for advisors and the executive director and things like that than it is to actual charitable purpose. So in these instances, sometimes we see a conversion, right? We see a private foundation convert to a donor advised fund. And what you see here is no more tax filing requirements, no more admin type of costs, right? I mean, you do have the 1% a lot of these folks on the call know better than me. You'll have the the AUM types of fees and the fees associated with donor advised funds, but they're generally a lot less than what you'll see in a private foundation. No more grant making and due diligence matters, no more investment income tax issues, all that sort of stuff. And even so, the non-financial component, the private foundation directors and trustees can still maintain advisory roles over the distributions from the DAF, and they can help set parameters and so forth for aligning with the private foundation's mission. So the last thing that I will say before I turn it over to Doug here is if you do want to convert one of these things, here's a slide on it. You have the slide deck. You can take a look at these. It's kind of technical. You got to walk through it and do it the right way. And I think a lot of the non-technical piece too is, these private foundations probably have nice relationships with some of their donees they want to continue to support. So working with those donees through this transition process to a donor advised fund is instrumental. So, with that being said, I think it's a good time to look at these things if your clients have them to make sure they're still making sense and still achieving the purpose the client wanted to achieve. And maybe they're not, and if it's not, converting to a donor advised fund could be an option or should be something to be considered. So with that said, I think I'm about 2 minutes over my time. Sorry about that, Doug, but I'll turn everything over to Doug now and be back on at the end to help answer any questions.
Okay. Thanks, Greg. I appreciate it. Very nice presentation. And we're going to then continue into my part of the discussion. Things that have happened recently that involve charity that you can talk to your clients about. The first one I want to cover is something that happened towards the end of last year that's going to have a great impact on folks going forward, and that was the passage of the Secure Act, and it set up was signed into law last December. And as I note in the slides, it's the first major retirement-related legislation in an awful long time. A couple things that it did. It raised the minimum age for required minimum distributions. That used to be 70 and a half under the prior law. That's now increased to age 72. So you don't have to start taking required minimum distributions now until age 72. Also allows workers to continue to contribute to traditional IRAs, extended that a bit, and a couple other things. Allows individuals to use 529 plan money to repay student loans, which is a big benefit. It did eliminate the stretch IRA. We're going to talk about that in a little bit more detail in the slides that follow. What it does now is it requires non-spouse beneficiaries of inherited IRAs to withdraw and pay taxes on all of the distributions within 10 years. Okay. We know the stretch IRA, again, we're going to cover that in a little bit, allowed you to stretch out the withdrawal of those accounts. Now it has to be done within 10 years. And finally, the Secure Act also made it easier for 401k plan administrators to also be able to offer annuities as part of their plans. So what I wanted to focus on was the elimination of the stretch IRA. Prior to the Secure Act, if you named a child a non-spouse beneficiary as the IRA, of the beneficiary of the IRA, the RMD, or required minimum distribution, was based upon the beneficiary's age. Therefore, you could stretch out the withdrawals from the account over the beneficiary's lifetime. As I mentioned earlier, the Secure Act now provides that the non-spouse beneficiary must withdraw the account over 10 years after the death of the decedent. So here's an example of how the Secure Act is going to impact things going forward. So in our first example, decedent died in 2019, obviously before the Secure Act, and had an IRA worth $300,000 and names their child, age 55, as the beneficiary. The RMD for 2020, if you had to take it, and beyond, is based upon the child's life expectancy, which, in accordance with the IRS tables, is 29.6 years. So the RMD in the first year, 2020, would be $10,135. You get that by taking the account balance, 300, divided by the life expectancy, or 29.6 years. In each subsequent year, the RMD is then the 12/31 account value, the prior year, divided by the prior year life expectancy minus 1. Okay, a lot of words, but what does it mean? So you see at the bottom of that slide, in 2021, you take whatever the account value was on 12/31/2020, divided by 28.6, which was the prior year life expectancy, minus 1. And then in 2022, it's the 12/31/21 account balance divided by 27.6. And that happens every year for your required minimum distribution. Under the Secure Act, same example with an IRA worth $300,000 and a child age 55. Now, under the Secure Act, the entire account must be withdrawn by the child within 10 years. If the child elects to take the RMDs over 10 years, then approximately $30,000 a year would be withdrawn if you do a straight line withdrawal. Note the child could take the entire account in year 1, just like prior to the Secure Act. You can take whatever you want whenever you want, or they could wait to take it in year 10, or any combination of the two. So what's the comparison? With the $300,000 IRA, before the Secure Act, the RMD is $10,000. After the Secure Act, if you do straight line, would be around $30,000. Okay? Does this, at the bottom of the slide there, does this increase the child's RMD, which would cause the marginal income tax bracket to increase? Probably not. $10,000 or $30,000 probably is not going to cause the child to have a higher income tax marginal tax bracket. Let's look at another example, however. And we live here in Pittsburgh. There's a lot of doctors that work for the various healthcare facilities here, and you've worked with physicians and doctors. They usually have pretty big RMDs. So this example is not outside of the realm of possibility. So we take the same facts as example 1, but the IRA value is $5 million. Okay. Before the Secure Act, the RMD would be roughly $170,000 a year. But after the Secure Act, if you straight line withdrawal, you're talking about $500,000 a year. So would that increased RMD have an effect on the child? Absolutely yes. that $500,000 is most definitely going to knock the child up to the next highest income tax bracket. What's the effect of that? Well, everything that the child has in income then would be taxed at the higher marginal brackets. It's going to push everything up. So is there a way to recreate the stretch IRA? And we have been doing this with a couple of clients already. We're only in June, but I've already done this for several clients. You would use a charitable remainder unit trust, or a CRUT, as a substitute. And that basically allows you to, in effect, reinstate the stretch IRA. Greg covered it earlier about the charitable remainder trust, but just in general terms here, what is a CRUT? During the lifetime of the beneficiary, a fixed percentage of the trust assets valued annually, is the key here, is distributed to the beneficiary. When the beneficiary dies, the balance of the CRUT assets pass to one or more charitable organizations. The key here is at the bottom of the page that the CRUT is a non-tax paying entity. It does not pay income tax. So each year when the child receives their unit trust distribution, they are taxed on that distribution based upon the character of the distribution coming out. So the CRUT then stretches the IRA distributions over the child's lifetime, because the CRUT pays out for the child's lifetime, and you've in essence recreated a stretch IRA. And then when again the child dies, the CRUT would go to charity, and the decedent in creating the CRUT can name the beneficiary, or the decedent can allow the child to name the beneficiary. So there's a lot of flexibility as far as naming beneficiaries as well. So let's give an example here. Let's use the $5 million CRUT that we spoke of earlier. And the decedent has the child 55, but he names a 5% unit trust payout CRUT as the beneficiary. The CRUT collects the entire $5 million in a lump sum and pays no federal income tax. In year one, the child would receive 5% of the CRUT value of $5 million, or $250,000. Now, just to make some assumptions here, 2% income, 4% appreciation, or roughly 6% total. In year two, the CRUT would be valued at $5,046,356, and the child's distribution, you can see, went up from $250,000 to $252,317. Same as the distributions from the old stretch IRA, where every year the distributions would go up a little bit because your life expectancy goes down. Again, assuming a 2% income and 4% appreciation, in year 25, if you run out the numbers, the CRUT would be valued at around $6.2 million, and the child would receive $311,000. So if we look at the end, assuming the child dies in year 25, the child would have received almost $7 million in distributions over that 25 years, and there would still be about $6.3 million left in the trust, which would go to charity. Okay? So that's how you can recreate the stretch IRA by using the CRUT. It's an excellent strategy to consider for larger IRAs. The first example I gave, the $300,000 IRA, probably doesn't make a lot of sense to do a stretch IRA there. But for the larger ones, the $3, the $4, the $5 million, where you have one or two beneficiaries, it can provide a significant income tax savings. It does operate, as we said, very similar to the old stretch IRA, spread out the distributions over the child's life expectancy. And the CRUT, again, is a non-tax paying entity. So the items of income and deduction that occur within the CRUT year after year are not taxed, very similar to an IRA or an inherited IRA. So the money just continues to accumulate inside the CRUT tax-free, again, just like the old stretch IRAs. I'm next going to turn to a separate type of charitable trust, and conceptually, it's the exact opposite of the CRUT that we talked about. This is a CLAT, or a charitable lead annuity trust, and I have there on the slide Never a better time than now. Why? Well, due to historically low IRS rates, they call them the applicable federal rates, there has never been a better time to do this. So what is a CLAT? Again, I said it's conceptually the exact opposite of the CRUT. Under the CRUT, the annual distributions are paid out to the individual, and when the individual dies, the money goes to charity. Under a CLAT, it's the opposite. The fixed percentage of the value of the initial contribution, not valued annually, although you can do that type of a trust, is distributed to charity. So charity gets the annual distributions for a term of years, 5, 10, 15, 20 years. And at the end of the term, if there's anything remaining, those assets pass to the heirs. So the actuarial value in their software programs, I think everybody knows about, that will do these calculations. The actuarial value of the charitable interest qualifies for the charitable deduction for gift tax purposes. So the gift is only the actuarial value of the remainder interest that passes to the heirs. So how do you do this to the most effective manner? And we say here the zeroed out CLAT. The client can actually select a term, how many years, 10, 15, 20 years that they want it to be paid out, and the payout amount, that when you perform the actuarial calculation, the remainder interest, the taxable gift to the heirs, is zero. And here's some examples based upon the current IRS interest rates. If you created a $1 million CLAT for 10 years, you'd have to pay out $103,000 a year to charity. You'll see if you increase the term to 15 years, that lowers it down to $69,920. And if you create a 20-year CLAT, you only have to distribute $53,210 a year, or roughly 5.3%. So you can see that if you're going to earn in excess of that, there could be significant money left at the end of the 20-year term that would go to the children, again, gift tax free. So let's take a look at the economic benefit of the zeroed out CLAT, assuming, again, a 6% growth. On the 10-year CLAT, remember that's $103,000 a year that has to go to charity for 10 years. The heirs would receive about $428,000 after 10 years, gift tax free. Pretty good, but it could be better. If you go to a 15-year CLAT that only requires the $69,000 a year payout, that amount would increase to almost $770,000 for the children after 15 years, again, gift tax free. The 20-year CLAT, which I'm doing for a couple of clients right now, only requires the $53,000 payout for 20 years. And then the heirs, the big number there, would receive $1.25 million after 20 years, gift tax free, free from all estate and gift taxes. So that's pretty powerful. If you can earn 6% on average of that CLAT over the 20-year period, you could get your children or your heirs an additional $1.25 million without using any of your federal credits for gift and estate taxes. Again, pretty powerful. So why now? The lower the interest rate, the IRS interest rate, the lower the term and the payout rate needs to be in order to be a zeroed out CLAT. We saw that with the examples that I gave in the previous slides. As that term goes out, the amount of the payout goes down, and as the interest rate goes down, the amount of the required payout for a zeroed out CLAT also goes down. Also, with the depressed stock markets due to COVID, stocks contributed to the CLAT now are more likely to appreciate. If you subscribe to the theory that the market is going to come back to where it was over time, again, now is never a better time to do it, because you're almost contributing stocks that have a built-in appreciation to the CLAT, and it may work even better. So at this time, I think we'll do my first polling question. Kate?
Yes. One moment, please. Okay. Which charitable vehicle can be used to recreate the stretch IRA? please answer one of these. Is it the charitable remainder trust, the lead trust, or a donor advised fund? I believe in you guys. I think you know this one. Okay, I'm going to close this. It looks like 89% shows the charitable remainder trust, which is correct. Well done. Well done, everyone.
Very good. Okay. Moving on. A good answer there. And again, that's the stretch IRA and the CRUD is something to consider when you have the bigger IRAs or retirement plans, because it does provide the potential for a lot of tax savings. So we're going to continue on with the discussion about the CLAT. And there are two types of CLATs that you can create when you do them during your lifetime: a grantor CLAT versus a non-grantor CLAT. The difference here, the grantor CLAT, in the year of funding, the client would receive the charitable income tax deduction for the actuarial value of the charitable interest. That is on their own 1040 in the year it is created. It is a grantor trust for income tax purposes, so the client would include all items of income and deduction on the client's personal return each year, and the client would not receive a charitable deduction for distributions to charity each year. So with the grantor CLAT, you get an upfront deduction, and if you zero out the CLAT, that's $1 million deduction in the year of funding, but then you have to include all of the items of income and deduction on your personal return thereafter without the availability of a charitable deduction for the annual distributions. The non-grantor CLAT is the exact opposite. The client does not receive a charitable income tax deduction in the year the CLAT is funded. The CLAT would then file its own income tax return each year and take a charitable deduction for the distribution to charity. So you can see, if you have a client that's going to have a large slug of income in any one year, you may want to consider the grantor CLAT to provide that charitable deduction. I think next we're going to do our second polling question.
Here we go. Okay. Which type of charitable lead trust would allow for a charitable income tax deduction in the year that the trust is established? Is it a grantor CLAT or a non-grantor CLAT? Please select one. Great. It looks like you all are very smart, and 92% said grantor CLAT, which is correct. Well done.
Okay, a couple other things that I just want to cover based upon the current interest rate environment that are some good planning opportunities. The first is a low interest intra-family loan. As we've talked about several times, the applicable federal rates are at or near all-time lows. Right now, a short-term loan, 0 to 3, less than 3 years, you're only required to charge 0.18%. Midterm, 3 to 9 years, 0.45%, and a long-term, 1.17%. So how does the low-interest intra-family loan work? Well, let's take a parent who loans $1 million to a child for 2 years and 11 months. So we know we are in the short-term category. And the note would call for interest of 0.18%. Assuming 2% income, 4% appreciation, which we've pretty much done throughout the slides, child would pay $5,250 in interest back to the parents over that term. The portfolio would be worth about $1.185 million after 2 years and 11 months. So the benefit to the child, they have the value is 1.185 minus the $5,250 that you had to pay in interest, minus the original loan amount of $1 million, means at the expiration of 2 years and 11 months, the child would keep $180,148 gift tax free. Pretty powerful, actually, for not a lot of legal work or any work to try to do this. It's just a simple loan with a note, and you pay it back. So low interest interfamily loans are a hot topic right now for trying to move wealth to younger generations. Again, especially if you believe that the depressed stock market has built-in gains, you're almost guaranteeing that you're going to be making pretty significant gift tax-free distributions to your children by using this strategy. Also, due to the COVID crisis, many clients have children who are unemployed or underemployed are in need of funds to accept their annual exclusion gift. We all know that you're permitted to give $15,000 a year to whomever you want, but maybe the child needs more than that because they're unemployed or underemployed. Well, the parents could consider making a loan to the child for the additional living expenses. You would document that loan with a note, and you would charge the lowest applicable federal rate. Even if it's a long-term loan, more than 9 years, you're only charging 1.17% interest. Then the child has the option of repaying the loan when their employment resumes full employment, or the child can let the note go unpaid until the death of the parent or parents, at which time the child's share of the estate can be funded with the note payable. In other words, you're treating the loan as an advancement on the child's inheritance. And finally, a couple other estate planning things to keep in mind. We talked about the annual gift tax exclusion. Again, that's $15,000 per year per person that you can give away. But don't forget that tuition and medical expenses are allowable gifts in excess of the annual exclusion gift. For tuition, it has to be for qualifying educational organization. It has to be made to a qualifying educational organization for the education or training of the individual. This counts for tuition only, not books, supplies, dorm fees, board, and things like that. So your client can cut a check directly to the qualifying educational organization for the tuition and still give the child $15,000 as an annual exclusion gift. Same thing basically applies for the medical care, as long as it's expenses for the diagnosis, cure, mitigation, treatment, et cetera, you are allowed to make those distributions in excess of the annual exclusion gift. Notably, the last sentence, it includes amounts paid for medical insurance. So if the child needs health insurance, if the parent cuts the check directly to the insurance company, they can do that in excess of the $15,000. That'll conclude mine. I think, Kate, we're ready for the Q&A.
Yeah, we have a couple of questions here. First question is, what do you think tax rates are going to do?
Greg,
Anybody?
Whoever wants to answer that one.
I'll give a stab at it. I guess here's what I'll say. I mean, we have a couple things going on. Right now it's pretty politically divided. I think if you have a situation where the Republicans kind of have some control here in about 6 months, versus the Democrats, I think if the Democrats are in control, there's a high likelihood you'll see some rates go up. Maybe sooner rather than later. But look, what did we just put in the economy? $4 trillion. I mean, at some point that's got to get paid off. So, I don't have a crystal ball, but I know if Democrats get in there, we'll probably see some more aggressive tax reform to happen. But at some point, you got to think, in the future, we got to pay for some of this somehow. I don't know if Doug, if you have anything else to add.
Not to make it a political conversation, but that, as with anything in DC, that's probably the root of what's going to happen. I think I can safely say they're not going to go any lower. And just to tie it back to my portion of the presentation, with the Secure Act, a lot of folks were having the conversation with them that you may want to take the distributions now or next year when the income tax brackets could be a lot lower. So it is definitely a good question and something worth watching.
Great, thank you. I'm gonna throw out one more question. Can a DAF receive payments, a donor advised fund, can a donor advised fund receive payments from a CLAT?
Yes. Yeah, as long as as long as it's a qualified charitable organization, it can receive it. We've done them where they went to a donor advised fund. We've done them when they went to outright to a charity. We've done them to fund a private family foundation. So yes.
Wonderful. Well, I think this concludes our hour together. I want to thank Doug and Greg so much for their time and expertise. And from Amy, Mallory, and I at the Pittsburgh Foundation, we appreciate you and we hope you have a great rest of the week. Take care.